Yeah, the shale revolution has had a big impact on the conventional tanker market, and that's because US crude oil imports have declined quite rapidly over the last few years. The United States used to import about 10.5 million barrels a day of crude oil in 2005, 2006, of which about 2 million barrels a day came from Canada, so their seaborne imports were about 8.5 million barrels a day. Now with the increase in shale oil production, those seaborne imports have come down to about 5 million barrels a day. So we've lost about 3.5 million barrels a day of crude oil imports into the United States. And if you think about the nature of shale oil, it's very light oil, almost like condensate. And so the types of oil that they've backed out into the States has been the light crude, which comes from West Africa, North Africa and the North Sea. So where it's really had the biggest impact is on the Suezmax sector. One of the main trade routes for the Suezmaxes was West Africa to the United States, and that trade route is really starting to die away as the US has backed out those light crude imports. And so what that's meant for the Suezmax market is, in the short term, the rates have come off. But looking further ahead, what we think is going to happen is that demand for crude oil is going to grow in the Far East. And we'll actually see an increase in crude tanker ton miles as Suezmaxes and VLCCs pick up in West Africa and in the Atlantic and take it long haul to the Far East. Because the US has a ban on crude oil exports, what they've tried to do is take as much of that shale oil as they can and refine it into refined products and export it that way. So the US refineries have been operating at almost full capacity recently, and they've been enjoying very strong refining margins. And if you think about what goes into making a strong refining margin, there's two major cost inputs to a refinery. One's the cost of the feedstock, and the other's the cost of energy for power. And what's happened in the United States in the last few years is the price of this shale oil is very cheap, so they have the cheap feedstock, and the price of shale gas is very cheap, so they have the cheap power as well. And so the refineries have been producing a lot of products, and that's been very beneficial for the Atlantic product tanker market, particularly the MRs. But when you couple that with a lot of the other positive stories in the product sector, such as refineries closing in Australia, in Europe, Japan, and new export-oriented refineries coming online in the Middle East and India, when you put all those together, it's a very positive product tanker demand story. If we went back a decade, the United States was really gearing up for massive LNG imports, and suddenly they found all this shale gas, and what they're finding now is they have a surplus of gas and it's available for export. So what's happened is that a lot of the terminals that were supposed to be import terminals have now applied for licenses to export LNG. So the US could become a major exporter of LNG, and the reason that's good for shipping is because if you're taking LNG from the US Gulf through the expanded Panama Canal, which from 2015 or 2016 will be able to take a standard size LNG carrier and take it round to Asia, you need double the amount of ships compared to taking it from Australia to Asia. So it's a very good ton-mile story, it's a very positive LNG shipping story, and for that reason Teekay ordered at the back end of last year 2 LNG carriers without an employment contract. And then in the last month or two, we actually employed those LNG carriers to Cheniere Energy to transport gas from their plants on the US Gulf Coast.